Chauhan from Abakkus Asset Managers LLP to talk about what he's making of the market right now. Aman, hi, morning. Good to have you on the show. Aman, just looking at how the year gone by has been, and I was just chatting with Kunal, my chart is that you can just draw a flat line, just a few odd spikes, and that's largely what we saw in December. Do you think the year ahead could be as quiet?
Definitely not. It's been one of the rare years where India is not relatively outperformed. When we see a flat chart, many people will be happy that, okay, they didn't lose money. But on a relative basis, we are amongst the bottom performers, like even the bottom quartile, right? All other markets are up double digits, or even some markets are up 20-25%, right? From that perspective, I think markets took a breather, good 3-4 years of rally, 1 year of time correction, or as we say, recharging the mobile phone kind of phenomenon. Once the tariff issue is behind us, which can be as soon as January, we thought it should happen in December, but we are already past mid of December. I think the US is soon going to go on a Christmas holiday. So December looks unlikely. If it happens around Jan, I think post that markets should start to pick up because domestically we are doing well. The economy is catching up, things are getting better. So that's what I feel. Definitely not a flat year, but in 26.
Aman, when will the mid and small caps get that supercharging?
A few months of rally, and then they'll also start the party. It doesn't happen that only large caps rally. There can be periods where only mid caps rally and large caps take a time to come up. But if large caps continue to do well, mid caps soon join the rally. So I don't think that should be an issue. If markets do well, I'm sure mid caps will also come in.
Okay. Aman, good morning. This is Harsh here. Aman, give us a sense. Your positive metals, cement, real estate, chemicals, all of those are largely cyclical. What are you most bullish on within all of these cyclical sectors?
So we are definitely positive on metals. We are more positive on pharma. We are also positive on domestic industrials. Not very much on cement or real estate, but more on, you can say, infra. Domestic growth is what we are banking on. X of consumers. So consumer sector will also do well. Clearly, there's a government focus to improve the consumption there. But valuations there are something that is not very attractive to us. And hence, we are more towards the manufacturing side of the economy. But these are the sectors that excited besides financial. So financial is something that is, I believe, a consensus call. Whatever rate cuts have happened, the benefits of that will start to look in from next quarter onwards. And that's something that is exciting to us also.
And Aman, what within financials? I'm curious of that. There's just so many ways to play it.
So we are predominantly into large private banks, large PSU banks, top 1 or 2 PSU banks, more of NBFCs. So for us, in the portfolio, there will be equal weightage of NBFCs versus what the banks are. And non-funded financial also. So we would have some AMCs in the company, some wealth management companies, right? So between the 3 segments, broadly, we are equally divided. So non-funded financials, top PSU banks, and large private banks. So that's broadly where the financial focus for us is.
Aman, I'm quite curious to know, how is it that you're looking at IT? Because I remember you guys were at Abakkus, were the first ones to actually turn bearish on IT. We all saw what happened to the sector in the last 2 years. But now, do you think there is material reason on the ground to become bullish on IT? Or would you say that this is just a catch-up trade?
We are neutral on IT. We are not bearish. We feel that larger companies will now report only single-digit growth because of the size. These are great companies, great businesses. Macro also is good. But if macro improves, the 4-5% growth that they had in the last 1-2 years is going to improve to 7-8-9%, which is still going to be a single-digit, which is not exciting enough as a growth investor per se, right? The mid-cap IT is interesting. That is something which I believe one has to be selectively picking up. And our focus is there. So we have trimmed our large cap IT exposure, but holding on to the mid cap IT that we have. We are not very overwhelmed because this is no longer a high growth sector. There will be currency benefits, but once the growth comes in, once the AI does or the digital transformation which the global worlds are going through starts to flow to these companies, the growth picks up, we will be looking forward to these same. Till that time, we can say neutralish stance.
Aman, Abakkus is known for value-conscious growth, right? And therefore, what gives you? Where are you more tilted towards? Are you more tilted towards mid-small caps at this point? Large cap compounders, is that what you're looking at? Because you hinted towards large cap compounders within the financial space, but how are you playing the mid small cap, and whether at all you're playing that theme as well? Give us a sense.
I think we are equally placed both sides. We never have this debate large cap versus mid caps. For us, at any given point of time, there will be some large cap which makes sense, there will be some mid cap which makes sense. Depending on where the value is, where the earnings growth cycle is, we'll invest. So today, I'll say it is balanced. It's not that only large caps are giving me value conscious approach of investing and mid caps are not. There are good amount of mid caps also where we continue to invest. So we are investing into NBFC, which are mid caps. We are investing into auto ancillary companies, which are mid caps. Some chemical companies, which are mid caps. Some platform companies, right? So for us, it's not a large cap versus mid cap debate anymore. So we are finding value both large and mid as we speak.
And Aman, you spoke about tech companies. So within that, especially the new age tech, how does one justify the kind of valuations they currently trade at? And if so, even with the higher growth, how do you pick the winners?
For a long time, we were conscious of this sector's valuations, and we were not heavily invested into this sector. In the past few quarters, we have started to look at these companies positively because many of these companies have now turned EBITDA positive, or the cash burn in these companies have gone, and hence now it makes sense for us to look at these sectors, right? Obviously, these companies needs to be looked from a different angle of valuation matrices. The traditional DCF or a PE or a PEG is not going to work because these companies can grow rapidly for a long period of time, right? So one needs to take valuation from that point of view. So if you're having a company which is currently a monopoly or a duopoly in its segment, then that company will trade at a significant premium versus the traditional sector, because here you are getting into a high market share scenario, and that high market share is going to sustain for years and years to come, right? So obviously these companies will trade at a premium. So we need to balance it out. So we are okay to pay a premium, but still prefer companies which are not burning cash or which are profitable.
And that, duopoly, Aman, like you rightly said, is playing out in a whole lot of sectors. I mean, everything from QCom to telecom, many sectors are seeing that kind of a defining trend.
Yeah, and we are now getting opportunities. And every month there's a new age company that is getting listed. Every week there will be some other company that are getting listed, which could be interesting. So from that perspective, the investable landscape is also increasing. And as I said, some of the companies which used to burn cash are now turning positive also. From that perspective, the investment landscape is clearly very attractive. And lots of monopolies and duopolies have also got listed across sectors, right? So now we are waiting for some fintech companies to get listed. There could be one or two new commerce companies which can again come into the market. That's where the excitement is. And I'm sure markets will pay a premium for these names.
Aman, is that the trend really? While in the Western and the Far East, it's all about AI. But for us, you think the AI play is consumer tech, if I can broadly classify it as that?
You can say so, because we don't have a direct AI play, or we don't have a large AI play or a direct AI play in that sense. So for us, platform companies are where you can see rapid growth. Why do people prefer AI? They prefer AI because that's what the future is, and that's where the rapid growth is. The same thing in India is, this is where the platform company, this is where the future is, this is where the rapid growth is. So that's, you can say, India's alternative to AI.
Aman, curious to know some of the decadal themes. Of course, new age tech is one of them, but outside, and AI could well be one of them as well. But outside of that, on traditional business, there's defense, and even EMS as a manufacturing play. How are you looking at those two?
So we are positive on EMS. Defense also we are positive. Fund exposure could be limited because of valuation concerns, but as a play, you said it right. These are decadal plays. Things are going to be good, rosy for them for next several years to come in. So clearly, if I have to put it in another word, it is import substitution. Every country in the world wants to become self-reliant to reduce dependence on imports. And India has been, and Modi has been saying so for more than 7, 8 years now. So that is what the play is. Defense is one of the sectors. Whatever else we import, chemicals, furniture, cap goods, etc. Whatever gets imported, India would like to manufacture it on its own. Like solar. Solar also, we are putting in huge investments to set up solar cell as well as module plants in India. So anything that is an import substitute is a decadent trend according to us.
And Aman, some of these plays could very easily become value traps, right? So I'm trying to get a sense. How are you tracking the metrics? What's the kind of growth you're penciling in terms of your expectations? And how are you picking your companies within this space? Are you picking companies within EMS with a better margin profile? Is that really the metric, or is growth the metric? How should one look at it?
We are investing for growth in these sectors, and hence growth is the biggest metric as to how diversified your client profile and your revenue profile is, and how long you can sustain the high growth phase. Because we have seen that even if you're a high growth company, if the growth rate decelerates, you used to grow at 60-70%, now you grow at 30-40%, that still leads to re-rating. That is something that one needs to be careful about, because you'll be buying the stocks expensive with a high P, right? So prefer companies where the growth rate is accelerating. If you're growing at 10, 20, 30, 40% and likely to grow at 40, 50, 60%, then I prefer that company. What's a company which is growing 80, 90%, still growing at 60%, which is higher, but deceleration, right? So accelerating companies is what our preference would be. And obviously, how diversified the revenue and the margin profile is. Margin, I think, is similar across most of these companies. So it's a very competitive industry in that sense.
Right. Okay, Aman, great to have you on the show, and thank you so much for your time. And here's wishing you a happy and prosperous new year from all of us.